Hi there, David from Critical Trading here. In today's video, I'm going to show you one of my recent trades where I traded against the majority of retail traders. On this trade, I will demonstrate to you how trading against the majority provides me with an edge in trading and how you can start doing the same to improve your trading. On top of this, I'm going to show you an extremely simple systematic strategy that has 70% win rate by trading against retail traders. Let's get right into it. Let's start with my recent trade. This was in soybean oil futures where I entered short, i.e. sold at close of this bullish candlestick that's highlighted in a yellow box. I trade on daily charts and so I entered short by using market on close order. My entry price was therefore at this level of close of this day and is highlighted by yellow horizontal line. Now, such entry may seem very risky for most people, and it is certainly not how the majority of retail traders would enter. The reality is that most retail traders would actually buy on close of this candle, and so I effectively bet against them. Such approach is nothing new to me. In fact, this is how I normally enter into my trades, despite this may seem risky at first. As most beginners follow various indicators and use these to enter, they are logically going to be delayed with their entries. On top of this, and that's very important, entering into already existing momentum that's clearly visible in the market is just much easier mentally. Think about it. It is much easier to buy on close of this highlighted candle than sell on its close like I did. Selling against the existing momentum is just very counterintuitive, which is, in my opinion, the main reason as to why most beginners fail to adopt such approach and ultimately fail in trading altogether. So if we look at what followed after I sold the market here, we can see another candle which is very similar to the one at which I entered. This one, however, is in the opposite direction. I'm talking about this massive bearish candlestick highlighted in yellow box. This is the candle on which the majority of retail traders are entering again, but now obviously in the opposite direction. And once again, they are delayed. As we can see, market changes its direction literally right after these retail traders enter. This kind of a pattern that I've just described, where retail traders seem to always be one step behind the market, is very common and takes place on any time frame. I've been using this towards my advantage for years now and has become a fundamental building block of my own approach. I strongly believe that when it comes to short-term trading, this is one of the very, very few principles that still work today. Now, let's quantify this. I came up with a simple systematic trading strategy that is trying to use this principle towards its advantage. This strategy buys when majority of retail traders are likely selling and closes its long positions when retail traders are likely buying. In simple terms, this strategy aims to take advantage of situations like the one I traded manually on the previous chart. So what are the rules? They're extremely simple. Strategy buys when low of the current candle is lower than the lowest low of previous 5 candles. It's a long only strategy and it closes its long positions when the current bar's high is higher than highest high over previous 5 bars. If I zoom in a little bit on this chart, we can see that this particular bearish bar that's highlighted in yellow box has broken below the blue line. The blue line is the 5 bar lowest low that I just mentioned that's used as a trigger for long entry. Because this bar's low broke below this line, the buy signal is generated. In other words, this strategy is buying at low of a massive bearish candlestick at which most beginners would sell, as it is far easier mentally. Buying at this candlestick is simply very counterintuitive, which is why most people would not do it. Now, the signal to close this trade got generated on this bullish bar, again highlighted in yellow. Again, this bar's high broke the level of 5 bar highest high plotted by the blue line. And that's it. These are the rules to open and close the trades. If you look at the chart, you can clearly see that this strategy approaches trading in a very counterintuitive manner, where it literally does the exact opposite of what's believed to be working in the markets. So what do you think? Can something like this have an edge in markets? So, going back to the strategy, I've got a backtest report open on the screen covering the period from January 2007 up to the end of May 2020. As you can see, this simple strategy that trades something that most people don't because it's counterintuitive generated 70% win rate. These numbers already include trading commissions and cover some of the major crises like 2008 for instance. Now, this is just a model strategy that I would not necessarily add to my systematic portfolio in its current form. There would definitely be more work needed on this one, but it confirms what I wanted to show you in this video. Now, what about if I swap the buy and sell rules so that the strategy will be in line with what most beginners are doing? These little buy and sell markers visible on the chart now show the inverted buy and sell rules. Instead of selling as previously, this strategy now buys when the current bar's high is higher than previous 5-bar high, and sells its long positions when the current bar's low is lower than the previous 5-bar low. So I literally just swapped these buy and sell rules so that they correspond with what the majority is doing. By looking at the chart, we can clearly see that this strategy is losing money in this type of price action. It simply enters far too late after the initial momentum has already been exhausted. And that's exactly what most uneducated beginners are doing in the markets, right? They keep waiting for a clear confirmation that the market is already moving in their anticipated direction before they get to pull the trigger. As I said previously, the reason for this is that doing so is simply far easier mentally than doing the opposite, as simple as that. But anyway, maybe it's just this particular type of price action in which this strategy is losing money. Let's look at the backtest results covering the same period from 2007 up to the end of May 2020. And there you have it, a win rate of just under 24% with the average losing trade being twice as big as the average profitable trade. The equity curve has exactly the opposite direction to what one would be hoping for. It is consistently decreasing. I ran this backtest with $10,000 as an initial capital, and as we can see on this monthly breakdown on the screen, this strategy would have lost it all halfway through the backtest. I personally found these results shocking when I first saw them, especially because if you think about it, this is exactly how majority of traders trade. They wait too long for the confirmation, and when they finally decide to pull the trigger, it is in most cases simply too late. This has just reinforced my belief that entries are absolutely critical in successful trading, and I highly recommend that you start looking into this area more yourself to improve your trading. And that's it for this one. Thanks for watching. If you're enjoying my content, then please consider subscribing. By doing so, you help me tremendously with growing my channel, and that's highly appreciated. This is David, Critical Trading, signing out.